Hey, everybody. Welcome to the Practical Founders Podcast, where every week we hear an amazing story from a serious founder who built a valuable software company and did it without big funding. I'm your host, Greg Head, and this week my guest is Dave Lambert, a managing partner of Rightside Capital Management. This is an expert episode with one of the most experienced investors in early stage SaaS companies around. Dave has been investing for 15 years at Rightside, but they have an unusual approach, almost an anti VC approach. They're very quantitative. They invest very early, just after a few customers with SaaS companies, and they've invested in over 2,000 software companies. So on this episode here, Dave is it's just an awesome episode. Dave is talking about what he sees today, how they think about early stage companies, how founders should be thinking about what they do when they get a few customers, and how they should be thinking about VC capital. And a lot of the lessons learned, having done this for so many years, that would be very useful to SaaS founders to help them succeed. So, most of what they're doing is practical funding for practical founders who aren't trying to create unicorn billion-dollar success stories. So, it's a great episode with Dave Lambert of Rightside Capital. Welcome to the Practical Founders Podcast, Dave. It's great to have you here.
Great to be here. Thanks.
Yeah. And you've been doing a very interesting version of the venture capital game after your entrepreneurial career. It's almost anti VC. I go to your blog, and there's things that I'm writing on the Practical Founders blog, on a VC investors blog. At Rightside Capital Management, right there in the heart of Silicon Valley and San Francisco, you're doing it very differently. And we're going to talk about what you're doing and all the implications for practical founders out there. So this isn't about selling big VC funding today, but you're a very wise guy and you've got a lot of practical tracks for practical SaaS founders. So Dave, why don't you tell us about Rightside Capital Management? Maybe you funded more companies than just about anybody else, but most people don't know about it.
Yeah, so at Rightside Capital, we describe ourselves as a pre-VC stage funding firm.
Hmm.
And I think there's two things that are very unique about us, or probably three. One is this pre-VC stage that we focus on. And most people think that when we say pre-VC, it's like an earlier stage of startup development, and it means we're investing
Yeah.
in ideas on paper. But actually, what we're
Yeah.
doing is we're investing in companies that are raising round sizes that are traditionally
Mm.
too small for the standard venture capital world to address.
Hmm.
Even pre-seed stage firms out there are generally investing in $1 to $2 million pre-seed rounds. We're
Hmm.
generally funding companies that are looking to raise anywhere between $100,000 and $500,000 as the total round size. So
So you don't say seed and pre-seed, you just say pre-VC,
VC,
like
yeah, and it
you're
has more to
getting
do
them
with the
really
round
early.
size. Yeah, it's the round size we're
Mm.
focusing on. And generally, the companies that we're investing in, it's sort of the cream of the crop at that stage. They tend to have a live product that's already generating revenue.
Yeah.
They're pretty capital efficient. They're either bootstrapped to that stage or they've raised a relatively small amount of money. And these are companies that tend to be just much more capital efficient
Mhm.
than companies that go the traditional venture route out of the
Yeah.
gate. So that's one unique thing about us. The other thing that's unique
Right.
is we use a quantitative data-driven selection process. And so when we interact with a company, we engage with them, gather up a bunch of data points, and we're usually a firm yes or no decision within about a week of getting all the data that we want from that company. And the other thing that's unique
So, yeah,
about us,
people can go to
yeah,
yeah,
people can go to
go ahead.
rightsidecapital.com, go to our web page. If you click on the submit
Yeah.
button, you'll get to our submit page. We list out exactly what our ideal investment profile is. And you can decide if you think you fit that or not. If you believe that you do, you fill out our pre screening form at the bottom of the page, and we respond to 100% of people that fill that out. And if you're a no, we tell you exactly why you're a no. So sometimes it's a no and there's nothing you can do about it. Sometimes you're a no and we say, hey, check back if this or this happens in the future. And then the reason we run this very fast, transparent funding process is because each of our funds, instead of having 15 or 20 or maybe 30 companies in it, has many hundreds of companies. So we're building out these ultra
Hundreds of
diversified
companies
funds.
in each fund.
Yep. Yep.
Yeah.
And so we've been doing this since 2012. We have invested in over 2,000 companies. Every company that we invest in starts out being worth somewhere in the low millions of dollars. And then we have companies that have grown to be worth tens
Mhm.
of millions, hundreds of millions, and billions of dollars. And we're pretty much okay with exit paths along that entire range of outcomes. And I think that's another thing that's unique about us. We're not specifically
Yeah.
unicorn hunting.
Right. We met last month in the Bay Area, and you're an investor, and I'm helping entrepreneurs out here who are staying off the institutional funding drugs. But the more we talked, the more we were saying the exact same things in there. And so you're a very atypical investor. You've been doing this a long time. You've got partners in your business that all help here, but you've invested in thousands of companies, and each fund is hundreds, maybe 400 companies that you invest in each fund, a little bit at the very early stage where VCs go. It's like, I know you're successful because you've been doing this for a long time, but
Mhm.
how long did it take before Silicon Valley entrepreneurs and investors and venture capital really understood what you're doing? They must have thought you were crazy for a long time. Quantitative approach,
Yeah, so
right?
it's
Quick
interesting.
turnaround on deals. Yeah.
As from the investor perspective, what we do, we break almost every perceived best practice in the venture capital industry.
Of the
We're
venture world.
we're
Yeah.
ultra diversified. We don't take board seats. We don't do follow-on investments. It's like all these things that are just it's just believe that's everything you need to do to drive great returns, and we sort of break all of those. And we're also investing at the stage where the perception is that that's where sort of friends, fools, and family invest, and not real investors for these
Yes,
small
right.
rounds.
The odds
And
are
we've
bad.
really bucked that trend. And it turns out that from we're really in the right place at the right time as well, because we started investing in 2012. And if you think about this it's a multi-decade trend. If you went back to the mid 1980s, it
Yeah.
took tens of millions of dollars to build a first version of a software product
Yeah.
and just
Yeah.
get it to the
Yeah.
state where you could prove or disprove if you could sell it. By the early 2000s, it was down to a few million. And boy, we thought that was so cheap then. It's probably down to $1 million by 2010. And then I think by 2016, we'd say it collapsed to 100,000 on average. And it's zero if you're a technical
Yeah.
founding team.
Yeah.
So the demand for these small rounds has just skyrocketed because there's been such an explosion of startup activity just around the country and around the globe. And there hasn't really been a good investor answer. So professional investors just
Right.
sort of ignore these small rounds, but there's more and more companies looking
Yeah.
for them. And we're just one of the only people playing in that space.
Yeah. That's amazing. What percentage of how many companies has your funds invested in the last, yeah, actually, how
I
many
don't know the exact
companies
number,
have
but it's
you guys invested in?
a little over 2,000. What's nice
Wow.
is because we're so diversified, we can take a lot of risk. So we're able to invest in
Yeah.
business models that have very high risk profiles. Able to invest in business models that are relatively safe within the context of tech investing. Whatever profile we're investing in, we're going to invest in a lot of those. So the math sort of plays out. And what we found is what's interesting is when we launched, we created this quantitative data driven process. And the end result was that we have this very fast, transparent funding product that's out there. And we built it for our own selfish needs. But it also turns out that it's the product that entrepreneurs sort of covet the most. There are almost no venture firms out there. If
Hmm.
you go to their websites that say exactly, here's what we're looking for and here's what we invest in. It's usually we invest in visionary founders trying to change the world, blah, blah, blah. And for us,
Hmm.
we
Hmm.
invest in companies raising sub 500K rounds, typically at $2 to $4 million valuations, mostly B2B SaaS, already have a live product generating these ranges of revenue. And if you think you're a fit, click here and give us your info. And that just doesn't happen much. And so we didn't realize when we sort of built our own processes how well it would work and how valuable it would be to the entrepreneurial world, which is sort of silly because I was a career tech entrepreneur for 20 years before this. So I should
And did
have.
you raise funding or were you bootstrapped before that?
Yeah. So I ran two companies. One was bootstrapped, a computer hardware company, bootstrapped in the 90s. One was a software
Hmm.
company in the 2000s. went down the more traditional path, raised from angel investor, angel group to VC firms. So I've sort of seen it all, and I was an somewhat active angel investor on and off from the mid '90s to the mid 2000s.
Right. So you've got this remarkable view of the software startup world. So if you're investing in hundreds of companies in each fund, maybe that's a few years each, something like that. How many companies are applying it that you're seeing? Are you getting thousands of applications a year to invest in 100, or, just
Yeah,
generally
it's a
what's out there
massive
beyond
number.
that that's
We don't
asking?
actually calculate the front end. A
Yes.
lot of VC firms will say, hey, we touched X number of companies. We try and put all the information we
Mhm.
can on our website so that you're not applying if you think you're not a good fit and you can screen yourself out. I mean, I can tell you that
Right.
personally,
Yeah.
I am probably, we get a lot of random inbound reach out from email, LinkedIn, all sources,
Yeah. Mhm.
not just through the
Yeah.
website. I'm probably getting 20 companies a day that I'm just to me directly
Yeah.
that's not coming through our website, you know, and then a smaller
Right.
percentage of those I'm redirecting to our website, and most of them I can just tell right away. I say, you're not a fit, and here's exactly why.
Right. Okay. So, and you're a straight shooter. You're going to tell them no right away. Here's the reason. And you're getting to a yes, we'll fund you in less than a week sometimes. Or is that your process?
Yeah, exactly. It all depends on your business profile, model, how quickly you get your data together. And generally, the speed with which we can make a decision is usually dependent on how much, to what extent a startup has their act together and has all their data
Right.
ready for us. Can you
Right.
provide us with historical monthly financials very easily? Do you have a list of all your customers? Do you have churn information? Do you have all this? Sometimes we meet with the company, they submit information, have a follow-up call the next day, ask for this information. It comes over 2 hours later, and we're in yes the next day, or a question or two later, and a yes. And sometimes it's a 3-week process back and forth because we look at it takes a while to get the data. We have some follow-up questions, discussions. And the nice thing is that if we're a no, we're
Yeah.
telling you why. And sometimes it's a no because we think it's a fundamentally flawed business model, like the unit economics won't work out. But
Yeah.
we'll tell you that and exactly why we think there's a problem and it won't work out. And you should
Mhm.
maybe think about it could be a problem for you, regardless of where your source of funding is from. Sometimes it's a no because you're looking to raise too much and you've already raised
Yeah.
a reasonable amount before. You can't fix that. Sometimes it's a no because for your business model, you don't quite have the traction levels yet, but we'll say, hey, if you get to this traction level, feel free to cycle back to us.
Right. And so it's some revenue, maybe 5 or 30K MRR, something like that in SaaS.
Yep.
Is that a is that a good
Yeah, I'd
starting
say that
point
that's
there?
probably like the middle 80% is in that 5 to 30K MRR range, with maybe
Right.
5% lower than that and 15% higher than that.
Yeah. And they have an up and running product, they have paying customers, but you're not calling the customers and saying, "Do you love it? Is that product market fit?" You're just saying, "Are
We're
these real
generally
paying
not. It depends on
customers?"
the
And
customer profile.
yeah,
You know,
I
if
see.
you've got 12K MRR and 15 customers, and you know, we're going to want to see signed customer contracts, bank statements, churn
Yeah,
data,
okay.
stuff like
Yeah,
that. If people are continually buying and paying and staying with you, that's enough for us to see. If you've got 10K MRR and you've got two $5,000 a month customers and they've only been with you for 2 months, well, we might want to talk to a customer or both of them to
yeah,
understand if they're liking the
yeah.
product or not.
So you're not doing the normal universal VC other than right side capital, which is lots of conversations, meetings, talk to customers, look at the market, evaluate a TAM, all of that voodoo stuff that at early stage almost
Yeah,
doesn't make sense. You're
it's the
looking at pretty
subjective
hard factors.
analysis.
Yeah.
Yeah, the subjective analysis is what takes forever, right? If I want to either myself or I wanted to have an associate model out this new market and try and predict how big it will be and what demand will be 2 or 5 years from
Yeah.
now, that takes a lot of time, right? If I want to do an in-depth analysis and see how this company and their product compares to the competition, that's going to take a lot of time. But we're not making
Yeah.
decisions on those things. And the reason why is what we found is at the stage that we're investing, most successful companies, they pivot and change and don't look anything like what we invested in anyway. We're basically investing in some jockeys, which are the founders, and some
Yeah.
starting business model with some amount of traction. And the reality is that if you're going to be wildly successful, rarely does your, whatever you think your ICP is at the time we're investing, it's rarely your end ICP if you end up with 10 or 20 million of ARR down the road. And the product is rarely
Yeah.
the same product. Sometimes it's just got a few different features and functionality that make it better. And sometimes you've thrown out your business model and you're doing something in an entirely different area that you've discovered. And because that's the case, that extra diligence just doesn't matter. And then the other thing that's sort of built into our DNA is that we think at these early stages, the difference between revolutionary and ridiculous is zero. And it's not only zero, if you
I
hire
mean,
an
you can't
expert,
tell.
you can't tell, they look the same. And if you hire an expert, or if you try and just screen out the ridiculous ideas, you're actually going to screen out the revolutionary ones because they're the ones that look ridiculous,
Mhm.
particularly to the entrenched incumbents. That's
Of
why no one's
course.
doing
That's
it. But
right.
when that works, you have no competition for like a couple years because no one else
Right.
is doing it. Or everyone's like, oh my goodness, I never thought that would work. So for all these reasons, we think it's just a much better strategy to implement this quantitative data-driven sort of portfolio construction. And it just turns out that from an entrepreneur's perspective, it actually is a lot more founder friendly. So it's sort of beautiful because it cuts both ways. We think it's better for us, and it's definitely much better for entrepreneurs.
Right. I think it's funny when somebody's up and running with a few customers and we're having those early conversations, me talking to a founder, they ask me a question about their market and pricing, and I say, I don't know. And neither do you. Like they're just barely
Yeah.
on the field. And there's a lot of confidence and hubris as they're getting going, but everybody has to get through that reality. So your business model is completely different in the venture world. And you're on your fifth fund, sixth fund?
Sixth fund right now. Yeah.
Sixth fund. So you've been successful with this so far. So it's working in providing venture type returns there with hundreds of companies in the portfolio. And you're solving this bad odds problem at that stage, even with a few customers, a little revenue, with a portfolio approach, meaning if you're playing the power law, a few are going to win big, most aren't going to make it very far. But if we invest enough, the more we invest with the right criteria, the better our odds are of making our return. You're solving it with quantity.
Correct. So
Is that right?
it lets us do a few
Yeah.
different things. One, it lets us take risks. So if sometimes we're investing in a company and we think, that they've already got a live product revenue. It's in an area that's a little less risky, and maybe this company has a 60% chance of generating some return, and some smaller chance of generating a decent one. We can invest in a lot of those. But if someone also has a business model
Yeah.
where they're going up against some huge entrenched you know, incumbent, and maybe they're only 5% likely to be successful. But if they are, they'll be wildly
Hmm.
successful. We can invest in a bunch of those too, because if it's only going to be successful 1 in 20 times, guess what? We're going to make 50 of those investments. So the math will play
Yeah.
out. So it allows us to take risk and step into this stage and invest in profiles of companies that it's not rational for other investors to maybe invest in. And that's, I think,
Yeah.
it really excites us because all of our partners, we're all career entrepreneurs. And so we've
Yeah.
lived and breathed the whole funding market. And we realize that it's that early stage of funding for these small rounds. That's where the entrepreneurial ecosystem really needs the funding the most. So it's just really rewarding for us
Hmm.
that we get to work with all these entrepreneurs starting at this early stage and sort of filling the void where the rest of the investor world has chosen not to play. So it's really
Right.
it's worked well, but it's just really rewarding, and it's fun. I was gonna say, you mentioned that, like, it's a power law distribution, and it is, and like the bulk of our returns might come from a small number of companies, but our model also allows us to be incredibly entrepreneurial friendly. Like, we're not trying to drive our companies to step on the gas, spend as
Right.
much money as possible, and shoot for a unicorn or bust. We actually have the opposite approach. We tend to think it makes the most sense for entrepreneurs to be capital efficient for as long as possible until you really know that you have a repeatable, scalable sales process, and then step on the gas. And then you get an idea of
Hmm.
how large you can be and how large your market is. And then you can decide, all right, should I be primarily bootstrapped and just raise money through SaaS loans and not dilute myself much at all and keep the smaller exit market in
Mhm.
play? Should I go after family offices as investors who don't have quite, as high multiple expectations as VC firms? Should I go to private equity, or is the venture capital path right? And ultimately, we don't care which path is correct for our companies. Our job is to educate you, and we recommend you operate on a path that they're all in play at first. And then we've got connections to
Yeah.
funders in all of those paths, and we just connect you to the right one. So I have hundreds of discussions a year with founders about what are the different implications of taking money from different profiles of investors, different types of debt providers. How does that limit your exits? What are the implications for you? Because as a founder, you're managing a portfolio of one. It's much easier for me.
Yes.
I'm managing a portfolio. Each fund has many hundreds. You're managing a portfolio of one. So
Mhm.
you've got to think about things a little differently than your investors do. That's our perspective.
Yes. What are the most common traits? I talk about funding being overprescribed and by funders and misunderstood by founders. What are the most common misconceptions that founders have about funding, institutional funding of all types that you help counsel them on for their
Yeah,
own
I think
good?
the biggest misunderstanding is that if you raise a large funding round, you raise that large $10 million Series A round, that you're more likely to be successful
Hmm.
because you've raised this large round and you have all this money in the bank. And actually, the exact opposite is true. You're more likely, your failure rate has probably doubled
Right.
if you do that compared to a different path. Now, the chance of you being
Yeah.
a massive tail home run probably has doubled or tripled as well. But in general, when you're going down that venture path, you're asked to step on the gas, grow very quickly, and it puts a lot more operational risk in play. Venture capital investors aren't giving you $10 million
Right.
dollars to have a lot of extra safe buffer in the bank. They're giving that money to you to spend and
Right.
grow. And so I don't think that most entrepreneurs appreciate that going down the venture path increases your failure rate generally. It might increase your expected
Yeah.
return if you got to do it 50 times because you rolled out those dice multiple times. But for an iteration of
Right.
one, it's a little higher risk and you put into play a much higher return. And that's just completely misunderstood. And it's not deception. Venture investors think that entrepreneurs
Right.
know exactly what they're doing and what the venture business model is. And most entrepreneurs just
Yeah.
simply don't. If you ask any venture capitalist that you're talking with, and hey, what types of exits would be okay with you? What's the operational risk you want to take? They'll be totally transparent usually and tell you. It's just the conversations don't happen because people
Yeah.
assume the other side knows about their business model when they don't.
That's totally true. So you also talk about on the blog, on your website, that every time you raise a round, raise $5 million or something, your risks go up and your exit number goes up by a magnitude by 10 times every time you raise a real round. And most companies don't get to the next round of funding, which means they're stalled or,
Yeah, yeah. So
or taken
the
out.
other thing I think people don't
The
understand is that when the profile of investor and the round size that you raise eliminates certain exit markets. So if you
Yeah.
raise a 5 on 20 round from a traditional venture capital firm, the venture model is that they're looking to have most of their companies, all the companies in their portfolio, say 20 companies, they all step on the gas hard, and somewhere between 1 to 3 sort of reach escape velocity and become these widely successful companies, and those
Mhm.
return the fund. And the others are some very, range between crashing to the ground and they're zero or just a very minimal return, or maybe the venture investors get their money back and founders get nothing. And that's that model. And that means they're not
Yeah.
looking for 3, 4, 5x returns on their winners. They want them to be 10, 20, 50x returns
Yeah.
or bust.
Mhm.
And so if you take
Mhm.
a 5 on 20, your post money is 25 million. If someone comes and wants to buy you for 75 or 100 million 18 months later, your venture investors are going to block that almost every time. They're going to say that's great validation. Let's raise
Yeah.
some money, step on the gas, and aim to 400 million or bust. And your potential investors will tell you this. If you ask them, it's just those questions aren't asked that much. Whereas if you raise from a different profile, private equity, on the other hand, tends to want to have all their companies be winners. and make 3 to 5x only in 3 to 5
Yeah.
years. But you have to get to much higher revenue numbers
Right.
to get to private equity. So it doesn't align often with a lot of tech startups. You can raise money from family offices who aren't managing funds, and they can recycle their money over and over, and they tend to not have these fixed return multiples they have to hit for each investment either. You can raise money from lenders, SaaS lenders, who have no say over when or where you exit. So there's just a lot of different things
When
that
you
are in
sell. Yeah.
play, and I just don't think founders understand it as much. And it's sort of the times. It was so much easier in the 1980s and 90s to be a tech founder because you could take any company public at any time as long as you were growing quickly. In
Yeah.
1994, if you took a company public on
Yeah.
the
Yeah.
NASDAQ and it had a $60 million market cap, wasn't unusual at all. If that company was out of business in 18 months, wasn't
Yeah.
unusual, right? So you just raised a round, whatever the largest round you could at any price at any time. And if you were successful, you could go public. And that
Yeah.
market is gone. It's such a higher bar to go
Hmm.
public. Now you have to figure
It's
out,
gone.
all right, how are my exit markets limited by who I'm raising from? All right, based on my market, who are the natural acquirers in my space? Are there acquisitions that happen at all stages? Some
Yeah.
markets, like healthcare, you can grow as large as you want, and there's always acquirers. There's some markets where, hey, all the acquisitions happen at like 50 to 150 million. And if you grow beyond that, boy,
Yeah.
your odds of getting acquired go down a lot. You've got to be
You're out of
so
luck.
big, you're the dominant player, and you're going public almost at that point. So it's just more nuanced and
Right.
trickier to be a founder.
So let's talk about, unlike other VCs, you're investing in early stage software companies that could get to a 30 million, 50 million, $100 million exit. And you don't know, and you're not betting on them being a unicorn. What does it look like in your portfolio when a software business gets started? They raise a little funding from you, and it's kind of a one and done funding, or maybe they use debt to SaaS lending on top of that. What does that kind of track look like for practical founders out there? Who could, this is
Yeah,
institutional
it's
funding, but
institutional funding from us.
the scale is,
Yeah, I would say that very few
yeah,
companies
yeah.
actually take our money and never raise anything else again. It happens, but that's pretty rare. Most companies
Okay.
raise some other
Okay.
capital, and some percentage actually do go down the venture channel. Some percentage raise one or two more
Yeah.
rounds, but the total amount they might raise might be $2 million after us. Some just raise a little or
Right.
none and just get to higher numbers and do take debt. What's interesting is that if we look back and see the largest winners for us that we've had in our funds have been companies that have happened to not raise that much money afterwards. And so there's not that much dilution for
Right.
us, but also more importantly, there's not that much dilution for the founders. However, you can have no clue
Right.
which companies these are ahead of time. In fact, I would say three of our
Isn't
largest
that interesting?
winners were business models and profiles that prospectively, if you had asked anyone in venture and even us to rank them on a scale of 1 to 100, how likely is it this company would be worth more than 500 million or a billion? We would have put them in the bottom 20th percentile, you know, and that just sort of shows how
Hmm.
it's gets back to that, there's very little difference between ridiculous and revolutionary. You just can't know that much
Yeah.
early on.
But there's a place in your portfolio for, let's say, the medium
Mhm.
wins, not the big scale wins, not the going out of business. There's a medium scale out there. And as you said, private equity, growth equity, they want everybody to win. So a medium win is 100% of what they do. But unlike most venture funds, like it's okay if a founder gets and sells it for
Oh,
50 million if they were capital efficient as you
absolutely. I
described.
was talking to a
Yeah.
company of ours just a couple days ago, and we invested in them. I don't know, they had like 15K MRR at the time that we invested. They're up to somewhere between 7 and 8 million ARR right now. They've just raised
Wow.
low single digit millions of dollars, not that much. And
Yeah.
they're running an exit process and will probably sell for, in their space, probably 60 million-ish, 60 to 70 million. And it'll be a great outcome for the founders, and we'll be more than happy
Yeah.
with the return. And there's no way to know. If you had asked us 3 or 4 years ago, maybe we would have thought, could this company get to be worth hundreds of millions, or would it be going to zero? Like, our opinion would have changed multiple times, as would the founders. But because they were pretty capital efficient and they never raised
Right.
massive rounds, they were able to keep all exit
There you
markets
go.
in play. And they decided that, hey, yeah, we could grow more, but we're going to go. And they're actually doing a dual process where they're exploring a full exit and also a majority private equity round. So actually, the founders are more than happy
Yeah.
to keep going another 3 to 5 years and take a little risk off the table by maybe selling half of their position and going it with private equity. So we'll see what happens. That's just an
Yeah.
example of an alternative path that generally isn't available or attractive to most venture investors.
And it really keeps the optionality for the founders to sell now or not, or to evaluate different types of acquisition scenarios and pause. And I talked to two founders this morning that had sold their companies and they refused the first and second offers because they were profitable and growing and didn't need to take an offer that didn't meet their criteria. That optionality is on the practical side is something you lose when you raise your 5 or
Yeah,
10 or
because
20 million,
when you're burning a
Series
lot
A,
of
B, C,
money, you generally are
round go.
forced to raise money when you have to, and sometimes you're forced to sell when you have to. And a lot of great
Yeah.
outcomes come just from both being good and
Yeah.
lucky. You happen to have the right business model in the right place at the right time, and your
Yeah.
sector, what you're doing, might not have been hot a year ago, but
Yeah.
now it's suddenly hot. And now you can get a valuation 50% higher, and you decide to raise money, or suddenly your exit valuation has gone up by 50 or 100% because there's a lot of consolidation and people are scrambling to buy companies in your space, or venture and private equity suddenly wants to get in your space. You can decide, all
Right.
right, I'll sell now. But because you were profitable, you weren't forced to have it to sell or raise money at some previous point in time. So yeah, there's nothing more powerful than being, a profitable, SaaS profitable business with recurring revenue is just as good as it gets, at the end of the day.
Well, we don't hear that from Silicon Valley venture investors very much, Dave. The P word, profit, which means you have negotiating power and you're not spending all the money and not desperate for more funding and so forth. So you don't mind a profitable and
It-
growing software company,
exactly,
maybe a
exactly.
rule
Like,
of
I'd say
40
in today's
company.
world, the last year or two, that P word has come up into discussions a lot more in the venture world, just because, we had a bubble that
Yeah.
popped and we're starting the cycle again.
Yeah.
Within another year or two, that word will be out of the conversation and it won't be back into the conversation for another 6 to 10 years till another pop happens and we start the cycle again. That's just how it works.
Next bubble.
But I would say an example of that optionality and where you
Yeah.
can be in a good place. And this is true of that company I just described a little earlier, because they're sort of a rule of 40 to maybe 50 company right
Hmm.
now, is that I'd say there's 3 areas of froth in the marketplace right now, and one is sort of pure AI startups. The other is biotech space is really frothy, which we don't play in
Yep.
that much. And then the other, which is
Uh-huh.
really sort of dynamic, has changed this year, is private equity. So, a lot of private equity capital has been built up on the sidelines and wasn't deployed in the last 2 years. Private equity tends to
Right.
have a shorter window to deploy capital. And so there's a lot of pressure to deploy that capital. And suddenly now, if you're a company that's, sort of in that 7 to 8 million plus ARR range, and you're at or near profitability with some growth, it doesn't have to be insane growth. A year ago, you might have struggled to get one term sheet in the private equity world, and today you might get 5. And if you were a company that was
Yeah.
out of cash and had to sell, you would have had to run that process a year ago, and you would have sold for a lower multiple. And suddenly, in
Right.
today's world, and probably for the next year or two, that same profile of company can find themselves, if they run a good process, getting a valuation that might be 50% plus higher than they would have gotten just from being in the right place at the right time. And that's just the value of optionality.
Right. Yeah, and I've seen this, and I've been doing this game since the '90s, like yourself. The sustainability of a profitable, break-even, recurring revenue B2B SaaS company gives it the resilience to not be desperate, not die along the way. It's a treacherous journey, but also to wait for luck to happen, right? The timing comes back to the market. The slow moving market that you started with finally picks up. Markets go up and down. A lot of practical founders I know sold during 20 and 21 when valuations were high. When you talk about like investing in these pre VC funded companies, SaaS companies, you say you can't tell which one is revolutionary and which one's ridiculous, which one's going to go to the moon and which one's going to bomb out. What is the implication or the lesson for founders there? If you can't tell, should founders be doing, being aware of this, meaning running the business to keep having more tries and be ready for the luck and right
Yeah,
and
I
not
we
make all or nothing bets? What's the implication for founders?
well, I think fundamentally, if you're a founder and you're starting a startup, you're sort of making an all or nothing bet, right? Because you're putting
Yeah,
a
yeah,
lot of time and
yeah,
resources, and you're working for no salary or very below market salary for a while. So
yeah.
that's just sort of the part of the natural optimism and irrationality of being a founder, and I was that for 20 years. But I think I would say two big principles that we're fans of. One is
Mm,
lean startup. And I think one of the problems with it becoming so cheap to build a software product is people have forgotten
yep.
how powerful lean startup is. Back when it cost a lot more money, it was really expensive and painful to build the wrong product. And it's
Right.
not as expensive or painful now, and people don't realize they have the wrong product sometimes. So when you're early on, if we're investing in a company, whether you've got 5,000 or 15,000 a month of revenue, we try and tell our founders, hey, for every customer that you have, you want to be having a call that customer up, ask if you can take 20 or 30 minutes of their time, ask them what they like about your product, what they don't like, what they wish any functionality they wished it had that it doesn't. But more importantly, ask them what are the biggest pain points in their job, just outside of your product. What are the things that are keeping them up at night? What do they wish they could solve? What problem do they have they wish could be solved that isn't? And if you do that to enough of your customers, maybe you talk to 20 customers and 8 of them say this pain point and this problem that isn't what your current product is solving. But it wouldn't be that hard to pivot into that, and you could charge a lot more to that for that. Like that's invaluable. And that's, the fact that you can get a product live in the marketplace, the real value is not necessarily this quicker revenue. It's this quicker
Hmm.
feedback loop from customers
Right.
if you're aware and
Yeah.
willing to take that feedback and create that feedback loop. And that's what's so powerful. So I'd say number one, basic lean startup practices, try and let your customer define the product, even if it's a totally different product than what you currently have. Number two is that I think most people completely misunderstand what it means to have product market fit within the scope of lean startup. So they think that if I'm just generating any revenue, by definition, I have product market fit. And that couldn't be farther from the truth. And a lot of investors misunderstand this too. What product market fit means is that your customers are almost pulling your product away from you. And many
Yeah.
successful
Yeah.
companies that get to 10 million in ARR never get true product market fit. So product market fit is you go
Yeah.
into a potential customer meeting, you start talking about your product offering, and they stop you 4 minutes in and they need to go get someone else to bring them in to hear this. Like that's
Yeah.
product market fit. And then if you take that to the next stage, what happens is because companies think getting revenue is product market fit, that once I have revenue, all I need to do scale is hire sales reps. But boy, nothing could be further from the truth. Like it's hard to hire and train and scale your sales process and sales reps. And so many companies burn so much money needlessly by hiring 2 or 3 sales reps. They have no training process in place, no idea what they're doing, and they just think these reps are going to come in and sell, and then they don't, and they burn a lot of money. And instead, the right time to hire a sales rep is when you've got a scalable, repeatable process that you as the founder can implement and run. And
Yes.
then
Hmm.
when you're closing new business every month, now let's see and prove, can you hire somebody that you can train such that they can close new business every month? How long does it take to get them trained? Once you've got data and know and have learned that, great. Now let's see if I can do that 1 or 2 more times. And so we see so many companies needlessly burn tons of cash just thinking that, oh, I've got to 20K MRR, let's hire 3 reps and scale. And 9 times out of 10, that's a bad outcome.
Well, those are two contradictions of, let's say, the VC investor playbook, which is they kind of force founders to say, I got 15 customers and I know what the answer is. I know where I'm going and it's time to scale. And we need 3 more salespeople. But you just said you got 15 customers, which is a license to get real conversations with people about what their real problem is to find really what your product you should be. And you shouldn't throw fuel on the fire, salespeople or marketing efforts, until you really know and have proven something repeatable. Most founders are thinking, I need funding, so therefore I need to declare myself and add
Yeah,
salespeople.
it's challenging. It's like the dynamics are exactly what you said. If you're a founder that goes out and says, "Hey, yeah, we've got 20 or 30K of revenue, but we're still experimenting and trying to figure out exactly what our sales model is and how to exactly scale,"
Yeah.
no one's going to fund you. Or, so you have to
Yeah.
have this
Yeah.
confidence and say, "Yeah, we know
It's a
exactly what
trap.
we're doing. We just need to throw gas on this fire and scale
Yeah.
up because that's what gets you funded." So then when you raise the money, that's what you have to do because that's what you've told your investors you're going to do. I don't have a great solution for that because if you tell them otherwise, more often than not, you're not getting funded. So it's definitely sort of a tricky situation.
But you don't filter for that one way or another. You're not asking them, do you know that you don't know what the answer is?
No,
Uh,
no,
you're
we
just
don't.
playing the odds that they're, enough of them will stay alive and figure it out,
Yeah,
and
yeah.
it'll
More
always be
often than
different
not,
than what they
even
thought. Yeah.
at the stages that we're investing, and someone has 4K, 8K, 20K MRR, they're still supremely confident and think they figured out their exact ICP and how it's going to grow and scale. And oh, we're just going to take your money and it's going to be straight up from here. And it never is,
Yeah.
or almost never is.
Yeah.
So yeah, we're having conversations a lot where we're just sharing this. Hey, just so you know, like 90% of our companies, miss their revenue targets massively over the next year. So you should assume that you are going to as well. But guess what? They all spend exactly what they thought they were going to spend or more usually. So just know that that's going to be the case and have a plan for where you're still alive if things don't go as expected. And amazingly, 100% of our companies where things have gone much better than planned, they've always managed to adjust to that scenario.
Yeah.
It's
Yeah.
when things don't go
All right.
according to
To solve
plan.
for the spending. Yeah.
Yeah,
Yeah.
yeah.
Isn't that
It's when things
interesting?
don't go as planned that companies run into trouble. And suddenly it's, oh, I thought I had 16 months of runway. And wow, that turned into 7 really quickly because I just believed my
Right.
spreadsheet blindly. You know,
Yeah.
that's common.
Well, David, another thing here, I talk to hundreds and hundreds of SaaS founders a year, and I'm inside in my peer groups in the companies that I advise. I'm inside 45, 50 SaaS businesses a year every month. And to a lot of people, that seems kind of crazy, but that's what I do. But it's just occurring to me that you've invested in over 2,000 businesses. You're probably getting the monthly investor update reports and emergency phone calls and therapy calls and all that kind of stuff. You're probably getting this mountain of feedback when you say 90% do this, and like you actually know that it's 90%
Yeah,
that do
that's
that.
the nice thing is
Like
founders do
you
tend to
must have
believe
more
them.
insight about the reality of this game than almost anybody from a quantitative perspective.
Yeah, almost any scenario that can happen in a startup, no matter how bizarre or weird, we will have seen in multiple times. All the normal stuff we'll have seen hundreds of times. So it does help, and it's a little more impactful. Like if I'm an angel investor and I've invested in 14 companies, and I'm talking with a founder, and I say,
Mhm.
hey, I think this strategy or this plan is high risk and not likely to work out. I haven't seen it work out at all in my companies. They might think, all right, well, you've only seen 4 instances. You're not going to do it. If
Right.
someone from our team is talking to one of our founders and we're going to say, we're almost going to never say we haven't seen it work out because we've seen people do crazy things and have it work out too. We'll
Yeah,
say,
yeah.
hey, the path that you're on right now, my best guess is on the universe of companies we've seen do this, you're probably out of business and dead within 6 months. And you probably have a 10%
Mm.
chance that you're going to pull a rabbit out of the hat and get this round of funding and go. If you want to go on that path and you're comfortable with that, it's, all your eggs are in this basket, but here's a path that you can go on or some decisions you can make that would probably give you more of a 60%
Yeah.
chance to be alive then, and they know that we're saying that having seen just hundreds of iterations of this thing.
Yes,
So
that's
it
amazing.
is nice because we're able to give that a lot of the value add that we have with our portfolio companies is feeding this metadata of information back to companies.
Yes.
What works, what doesn't work,
Right.
what's high risk but worth doing because when it works out, it's gold.
Right.
What's seems high
Right.
risk and worth doing, but even when it works out, it hasn't worked out that well. So you probably shouldn't try it, you know? Yep. So we
Yeah.
say all that. But
Well,
the
isn't
thing
it
is, you have to
interesting that
say it all humbly
go ahead.
because even still, the craziest things can work. Like my personal example is when I fired my first company out of school, there were no entrepreneurial resources in 1992. And I came up with a business
And you
model
went to
that
Stanford
involved,
in Silicon
yeah,
Valley, right? And
Stanford, Silicon
yeah.
Valley, 1992, zero entrepreneurial resources. And I had a business model where I was going to have a retail store that was selling some hardware, and all I had to do was be profitable after month 3. Like if someone came to me right now, I'd say that's insane. A retail store, you're going to sign a lease contract, give yourself, you need 18 months to be profitable or something. But no one there was there to tell me I was crazy, and we were profitable after month 3. So we view our job as just delivering our insights and information, and it's the founders' businesses. If they want to ignore it and choose a different path, they've got a lot more
Yeah.
riding on the line than we do. So it's always their choice, and we support whatever decision they make. All we can do is share our insights and data.
And you're not on the boards of all these companies by definition, and you're not talking to every single founder you've funded, right? I know you have a team of
Correct.
people that helps with go to market and selling and marketing and so forth, but and that you're doing more group oriented education events for your portfolios, but you're not like a controlling member of the company. You're a
Right, correct. We're
helpful
not
friend.
We're a helpful friend. We're not taking board seats. We are there anytime you want to talk about anything. We have sales experts, marketing experts, fundraising experts, massive fundraising network. All those people you can reach out and engage with as you need it. You can reach out to me or any of my partners as needed. We put on monthly webinars, have some live events. So that's all there. And people,
Yeah,
you make the
yeah,
mistake and think, one of the things we need to tell our founders, some of our founders get a little intimidated by how many companies we have, and they're hesitant to reach out to us because they're like, oh, you must be just
yep,
overwhelmed with a fire hose of people needing help. And it's much less than people would think because
yeah,
we've got a team of people, and it's only a small percentage of companies that have something that needs triage at any given time or wants to bounce something off us. And these aren't 2-hour calls, they're 15 and 30-minute calls often. And we can do a
yeah,
lot
yeah,
of it. And
yeah.
we've got a lot of people. So
That's awesome. And are you doing investments and support of founders outside the United States or North America?
a little bit, I'd say that like 90% of what we do is the US and Canada, and maybe 10%,
Okay.
5 to 10% is overseas. And there's two reasons for that. There's just, tax breaks that exist here in Canada that don't exist elsewhere.
Yeah.
So, we get QSBS tax treatment
Yeah.
here for US companies. In Canada, there's tons of subsidies early on. But the biggest thing is just that the reality is there's a lot more exits for US based companies and Canadian based
Yeah.
companies than there are overseas. And we've got this enormous network. We've got about 1,200 investors that are pre-seed VC to late stage private equity that we can connect our founders to at every stage of their life cycle. But the vast majority of those don't invest overseas. And so if you
Right.
get those next levels of traction, we can't be nearly as helpful and help connect you to next round funders
Right.
if you're in Chile or you're in France as we can if you're in Omaha or in New York. So those are the reasons why. So usually when we do invest overseas, it's a much higher traction bar that you have to be at.
I get it. Let's talk about exits here for those practical exits that would be successful. Maybe 25 million at the low end, 100 million there. Of course, there's bigger ones, in VC funded exits, the occasional ones. What's happening that's different than 5 or 10 years ago in that, $50 million exit plus or minus? Is it just private equity has shown up that wasn't there before? It's not an IPO world anymore. What are you seeing out there with the companies in your portfolio?
Yeah.
This is how you get paid back and make your return. So, what are you
Yeah.
seeing in
There's
exits?
two. Well, I'm going to answer it from the perspective of entrepreneurs more than from us a little
Okay.
bit for now, because I think it'll be the most interesting. So and I'm going to go back to like 10 years ago, let's say early 2010s to now, what has changed? And two
Yeah.
big changes have occurred. Number one is if you went back then, private equity, you needed at least 10 million ARR and often higher to get
Ah,
interest from private equity. And the private
right.
equity world has grown and they've come down lower. And even in that 5 to 10 million ARR range, you might put a third of the private equity world into play. So that's just a lot more
Yeah.
exits,
Wow.
lower valuations that are available. The other
Okay.
thing, and I think this is the biggest thing from a founder's perspective that has changed, is that prior to like the early 2010s and before then, if you took any liquidity out as a founder before the final sale of the company, that was
Ah,
frowned upon. And everyone thought if the founders get any liquidity, they're going to lose their hunger and the company won't perform as well. And that there's been a complete sea change there. Investors, for their own selfish reasons, because these later stage funds got so much capital that there was way more capital
yeah.
trying to be deployed than there was space. Suddenly, investors said, well, maybe it's okay if there's some liquidity to founders because we want to put more money in this company and we'll do some secondary transactions. So, as a founder, you used to be limited because if you went down that higher risk path, you increased your chance of a zero and there was no liquidity until the end. In today's world, that's different.
Right.
So you have to know that that's there
Mhm.
and you can ask for it. So just yesterday, I was talking with a company of ours. They're growing very quickly.
Mhm.
They're on path to be profitable. They've got about seven. There's a different company happens to also have 7 to 8 million ARR, and they don't need to raise any more money. They have a path to get profitable, but they had a bunch of inbound interest, and they're raising a $20 million round at a $130 pre-million
Mm.
valuation. And they asked and they said, we want an additional $10 million for founder liquidity for the three founders. The round was massively oversubscribed, so that was no issue, and they're getting that. But you know what? The investors
Yeah.
aren't going to offer it. You got to ask for it. And if they had
Mhm.
asked for that in 2012, the investors would have been like, no way. I think if you get that money, you're going to lose your hunger and not work as hard. And now investors realize, when entrepreneurs get that first taste of money, it maybe makes them want the rest even more. And so I think as founders, you've got a lot more options. There's more exit opportunity in that 50 to $100 million range. Also from 50 to 500, there's opportunities for you to take a round and take some money off the table personally and diversify your risk a little bit.
Right.
And you should do that. And you just have to know to ask for it. Investors won't be offended like they used to be.
When private equity, growth equity, or even a VC investor offers a secondary, these are like 2 bites exits. You get a little now. The founders get to take something off the table and keep betting on their company. Do you, as an investor, take money off during those secondary or,
Yeah, we have too.
partial minority majority exits?
Yeah, if you're a Series A investor and you're looking to sell into a Series B or C round, well, that's a flag, right? People are going to be like,
Yeah.
well,
Okay.
if you're looking to
Yeah.
sell, maybe I shouldn't be investing. But if this really early investor that put 200,000 or
Yes.
$300,000 in is interested in selling, it's not offensive to anybody, and we get offered sometimes too. A lot of our liquidity has come from secondary transactions, and sometimes in private equity rounds that happen. Sometimes they're majority takeovers, and the private equity firm will buy out all existing investors and maybe buy a third or half of the founder's position. And then the founders keep
Yeah.
50 to 70% in, and they go along for the ride with the private equity firm. Let's try and triple this or more again over the next 3 to 5 years. And that's a great outcome for founders because they're getting money out now,
Yeah.
and it's a significant amount, even if the whole thing goes to zero. It's a financial impact, very financially impactful, and they're putting more in play in not too long of a time. So
What happened to the old strategic buyer before all this 2 bites exit kind of game and secondaries? You either went public or somebody, Microsoft, a big company, bought you, paid cash or used their stock, and founders, got it all at once up front. Is that a very small part of the market? You didn't even mention the
no, that's still
strategic
there. That's
acquirers
still
there.
there. But I
Okay.
think where it used to be harder for founders and for us as really early stage investors is in the 2000s, the 2000s and early 2010s, your exits were strategic acquisitions or IPOs.
Hmm.
And there were almost no IPOs.
Yeah.
And the reality is that most strategic acquisitions happen at sub $50 million valuations and
Yeah.
hardly any happen above 100 million. And so once you got above 100
Hmm.
million, your chance of an exit just dropped so substantially. It was crazy. But that's just not true anymore, both for investors and founders. There's
Okay.
such a robust secondary market out there, both secondary funds, family offices, venture capital, and private equity firms willing to have secondaries as part of these larger rounds. So both early investors and, more importantly, entrepreneurs have lots of liquidity options as you get north of 100 million. And in fact, in today's world, once you get to those higher valuations of doing rounds, it's actually almost easier to get liquidity from funding rounds and around there than it is to sell your company. So there's just a lot more optionality. Strategics are still a major, major part of the equation. And I'd say by volume, more of our exits are strategic acquisitions than anything else.
Okay.
Though our
Right.
largest, liquidity events for our fund have been secondaries for some of our massively successful companies that were so wildly profitable, they were never going to raise another round and they weren't looking to sell.
Ah,
So, you
yeah.
just never
You
know.
need to get that off your books and so forth. You talked about AI focused companies. I went through your, submission form on your website. I love the cartoon that's been up there for years and years.
Mhm.
That's right there at rightsidecapital.com. But you didn't really ask about what's your AI strategy, or at least I didn't see it in your submission form. How are you thinking about AI? I know that most VC firms who have big checks want to fund the next wave of explosive growth AI focused players. How are you viewing it these days?
Yeah. So here's our views on AI. So we didn't rush in sort of to the AI frenzy post Chat GPT sort of being launched onto the world.
Yeah.
We naturally invested in some that just met our criteria, but more importantly, lots of our companies
Yeah.
just pivoted into the AI space. And I think that
Yeah. Uh-huh.
ultimately, as an analogy, I think both sort of databases and the internet are good analogies. At some point in the 70s, if you were a startup and you used a database just on your back end anywhere, you might have considered yourself a database company, right? But by the
Hmm.
1980s and 90s, well, all startups, lots of startups use databases. That's just a tool you use. That doesn't make you a database company.
Hmm.
You're a database company if you make the databases. Same
Yep.
thing in the late 90s. If you were a brick and mortar retailer and you started selling online and you had a website where people could buy stuff, you were an internet company. Well, within a few years,
Yeah.
by the mid 2000s, you weren't an internet company. You're a brick and mortar retailer that has a website. That's just internet's just a tool that you use. And I think that's true with AI as well. Like a lot of companies that were perceived as AI companies in the first 12 to 24 months after this AI frenzy, in hindsight, we're going to look back and be like, oh, those aren't AI companies. They're just using AI tools that are out there. And
Hmm.
in a very short period of time now, all companies are going to use AI tools throughout both their product and their back ends. And that's what we've seen in our portfolio. So within 6 months of GPT being launched publicly, we did a survey and it's somewhere between 70 to 75%, I think, of our companies were already using
Oh,
AI tools internally to streamline their operations, whether it was,
yeah. Of course. Right.
developers,
Yeah.
content
I
generation,
see that.
customer service. About 30 to 40% were already doing integrations into their products. And I think the way I view it is this it's really to invest in a pure AI company. Those are companies that are raising tens of millions of dollars usually out of the gate, right?
Yeah.
Then
Yeah.
you're investing in companies that use AI to solve a niche problem in some niche vertical, maybe. And that's where the world's going to change. Like that's where we've seen such huge
Yeah.
differences for these
Yeah.
productivity increases. So
Yeah.
within our portfolio, we've seen companies that have taken the AI tools out there, build AI, quote unquote, AI products, and solve problems that companies didn't know could be solved and are seeing revenue growth that's so crazy, it just couldn't have happened, just a few years ago, and they're doing it with less employees than you ever could have imagined because they're using these AI tools
Hmm.
internally as well. So one of the things that I think is going to happen, and we've talked about internally over the next 5, 6 years, we're probably going to see a couple companies in our portfolio that become billion-dollar companies with like 30 or less employees because they're going to use AI technologies to create a quote unquote AI product that solves some problem or does something that no one knew could even be solved so well with this. And if you had even
Yes.
asked someone in the venture space beforehand, hey, I'm going to solve whatever, hiring for amusement parks, I'm making that up, but that's not a big market. But lo and behold, someone does something that revolutionizes it, and suddenly they're generating tens of millions a year quickly, and it doesn't take them many people. I think that's the big change that's going to happen. And that just it's going to sort of turbocharge the capital efficiency trend for certain profiles of companies.
Yes, here we go. Make everybody more less desperate for venture funding and more efficient in their businesses and higher value for their customers. Very
Yeah.
practical stuff there.
I was just going to say, we've seen companies that have done this and they've gone to market with a product that their customers, it did stuff their customers weren't looking for this because they didn't even know it was possible to do this. And suddenly they're like, oh
Hmm.
wow, like this is game changing. And
Yeah, that's
and it's
amazing. Yeah.
like you can and we've seen some very quick sales at some very high priced products like that. And I think there's a lot of companies doing that in sort of niche areas. And you've got founders that know that space and know that, hey, if I solve this, this would be a huge market. And us generalist investors would have no clue. And if you ask us if that's a big market, we'd say no, you know, prospectively.
Yeah. I love how your business model doesn't depend on you knowing where the future is
Yeah,
and who
fortunately, it's
exactly is
not
going to win.
dependent on
So,
our generalist opinion that lets us invest in things that we don't necessarily have expertise in.
yeah, awesome. Well, thanks for sharing your practical insights for SaaS founders out there. Dave, what advice can you give practical founders who are building valuable software companies without institutional funding or very capital efficient, as you've described, leveraging AI and getting on the field with first customers? Maybe that getting to a million ARR, crowd all over the world. What advice do you have? A few points for them on how to play the game and increase their odds of succeeding in their achieving their vision their way.
Yeah. So, I mean, I think some of the stuff I've said before, embrace lean startup. Go read the original lean startup
Yeah.
books and,
Eric Ries.
have
Yeah.
as many interactions and discussions with your customers about what their points are, how to improve your product. What else could your product be doing?
Yeah.
Just do all that research. It's not fun and it's painful to do, but have 40 conversations with prospective customers early on like
Yeah.
that. And it's just so valuable. That's number one. Number two, unless you're just a horrendous salesperson, and sometimes founders are, you want to get a repeatable sales process that you can do first before you go out and start scaling and hiring other people. I'd say number three, leverage AI tools internally for operational efficiencies where you
Yeah.
can. Your developers should be using AI to be more productive. You know,
Yeah.
maybe your customer service, is it applicable to your product? These are just productivity gains that make differences. And then I think the last point is, venture capital isn't necessarily evil either. It's not to be avoided at all costs.
Yeah. Yeah.
It's just
Yeah.
realize what you want to do is get to a point where you can feel and understand your business model, prospective customers, and understand how large your opportunity is and how big you can get. And then once you understand that, then you can figure out what are the right funding paths and are the most synergistic. And I think that ultimately, one of the things where entrepreneurs get brainwashed, sort of from the press and media is, you know, a large funding round from a big name investor is not a success. The only check that matters is that last check in. And, another way to look at the world is that every funding round you have to raise is a failure because you're giving someone else part of your company. It doesn't mean you should expect to bootstrap and never raise any money. That almost never happens. But
Hmm.
success is not defined by your funding rounds you raise. Success is defined by building a profitable, growing business and selling it eventually. And it's difficult because if you have two founders running two different companies and they both get to 30 million ARR, and one does it by raising $5 million from angels and some small funds and some family offices and investors you've never heard of, and another one does it by raising 180 million or 200 million from very large name investors. That second founder that raised all that money from large name investors will have had 50 articles written about them, and everyone will know who that CEO is. And yet they will just own a fraction of their company. And that other CEO you've
Yeah.
never heard of is really wildly more successful and will own a majority or a huge chunk of the company still. And long
Awesome.
term, you'd rather be that first one, not that second one. You know?
That's why we're talking today. Very practical
Yeah,
advice.
yeah.
And I mentioned the cartoons that right there on your homepage. You described that right there. The difference between those two founders, the capital efficient founder and the the VC overfunded founder.
Yeah.
Which
And the
we've seen a
cartoons
lot
on our
of.
website are funny because they're true, right? Because they're true. And that's
Yeah, yeah,
just
painful.
the reality. Yeah.
Yeah. How should founders who might be interested in right side capital interact with you? Just go to the website and see if it's a fit and fill out the form. And
Yeah. The
if
best
not,
thing,
yeah,
if you're looking for funding from us, go to the website, fill out our pre-screening form. Like I said, we respond to everyone who fills that out. If you just have a question you want to run by me that's just unrelated to applying for funding or something, you can just reach out to me via email, dave@rightside.capital.com. I
okay,
get a
great.
lot of email, but I try my best to reply to everybody.
Yeah. Well, thanks for being so founder friendly for hundreds and thousands of SaaS founders who are changing their world in their corner of the universe and trying to build something amazing for their customers, employees, and themselves. Thanks for being a supporter of Practical SaaS Founders, Dave.
Very, very happy to do it. I think that's the most rewarding part of what we do. It's great when we make a good return,
Yep.
but it's even much more rewarding to see a founder that we've built up a relationship with and are really rooting for them get the big win. There's just nothing better than that.
Like it. Yeah. Awesome. Thanks for being on the Practical Founders podcast, Dave.
Thanks for having me. Bye.
Thanks for watching this week's founder interview on the Practical Founders podcast. Be sure to hit like and then subscribe to my Practical Founders YouTube channel to keep up with my weekly videos for serious software founders who are building valuable companies without big funding. Check out my blog and information about my Practical Founders CEO peer groups at practicalfounders.com. And follow me on LinkedIn to keep the conversation going. See you next week.